and this is the 30th, okay, on August 30th, yesterday, for gold. Now, on Wednesday's video, I specifically stated that should we get that bullishness on the dollar, which is the bias we held going into Thursday and Friday, this would be bearish. Okay, it would be very bearish for gold. In your notes, this is where we start talking about the gold price action model. Okay, this is a very specific model. There's not a lot of moving parts to it. If you're looking for an opportunity to trade things outside of Forex and you want to trade a metal, okay, you want to be trading gold in the New York session. Its price action is so pure and clean in the New York session. You can trade it in London. There's nothing wrong with trading it in London. I just prefer to trade gold during the New York session. Okay, so New York, 7 o'clock in the morning, local time, New York, to 3 o'clock bond close in New York time. So we have our specific time window. It's 8 hours. And you need to be aware of certain criteria that leads up to that particular session beginning. All of you should be familiar with my Power 3 teaching, which is the open, accumulation, distribution, open, high, low, and close, basically, of a daily bar. If we're bearish, we want to be trying to sell short at the open or just above the opening price and then ride out the expansion on the downside and getting out at a specific time window before price comes off of the daily low and closes just a little off the low. That's Power 3 when we're bearish. The reverse is said when we're bullish. We think that the daily candle is going to open near the low of the day, maybe trade a little bit lower than its opening price, create the low of the day. Smart money will accumulate longs there, ride the daily range expansion all the way up to around 10 o'clock in the morning to noon, local New York time. Then it'll come off the high and close near the high when it's bullish. That's Power 3. It's accumulation, manipulation, distribution. That's Power 3. So we talk about it in the mentorship. I have free tutorials about it as well. Applying that to the New York session, which is what these blue lines delineate here, okay? Treat this as the daily range. Nothing's different because price is price. The catalyst to this working is applying algorithmic principles. So I'm dabbling with the content that will be the primary focus with the trading plans next year. When we start in January, we'll be fleshing out the price action models into trading plans and also teaching algorithmic principles. And again, that's charter levels, so don't freak out if you hear that and you're like, yeah, I'm gonna start learning. Core content members won't be getting those lessons. They have to get into charter member to get to that level. Otherwise, I'm just going to get flooded with emails and questions, and it'll be very frustrating for you because you don't know the core content. So that's the pathway to get to it, okay? It's a process. So before 7 o'clock in the morning, we look at price action just like we do the price action before midnight when we're setting up for London. We delineate our chart. 7 o'clock is the window we're looking at. We're saying, okay, we're beginning to see what the market's going to do leading up into the 8 o'clock hour and the 8:20 CME opening. And again, these are all things that I talked about and taught in the mentorship core content. So if you haven't gotten that lesson yet, this is the part where you write down what is the CME opening and you'll know when you get to it. You'll know what that means and what you do with it. But I look at the market, how it's trading right before New York open. And I love to see when the market goes into a range, a really clear, discernible range during the London lunch. Okay? So between 5 o'clock in the morning New York time, local New York time, find out what that is and exactly in your broker. So set a clock. You should always, when you're dealing with me, when you're listening to me, you need to have a world clock set to New York local time. And that way, every time I say something, go to your charts at that time, and whatever your broker's platform candle is for that hour, that's the one you annotate on your chart. Okay, so it's really simple and saves me a lot of trouble. That saves me a lot of trouble and aggravation and confusion for you and me, because I'm not about to sit down and do 20,000 people's conversion to a local time in New York relative to where they are in the world. I'll go nuts if I try to do that. So again, it's real simple. World clock, set it to New York local time, 7 o'clock in the morning, New York time. What has happened prior to that hour? Did London lunch consolidate? We can see very clear trading range in here, just like I talk about leading into the Asian range into midnight. That Asian range, you can do a lot with it. Well, this same range, I apply that same concept to the opening range, and this is what this is. It's mine. You can't go to books, can't go to courses. Okay, you can't do any of that kind of stuff that you're learning here. This is the New York opening range. Okay, so New York opening range, once we have a clear defined trading range leading into it, that's the precursor. You have to have that. If you're seeing like a movement like this right ahead of the New York Open, you don't do anything like this. You wait. So you can see on the 30th, we had a consolidation, really beautiful consolidation. I used the range high and the low. I'm using the wicks, and you want to do the same thing across every single day that you do this. And you're going to see that there's a really systematic way that the market is delivered algorithmically. If it was completely random, if it was based on supply and demand factors, these things would not be in the charts. They would not be this precise. It would not be so consistent. Because remember, the assumption and the statistics, if you believe them, is that everybody gets it wrong here. So if everybody's getting it wrong, then it would justify a completely random market. But it's not. It's completely structured. Okay, and let's take a closer look here. What was the premise going into Thursday and Friday of this past week for the dollar index? We mentioned that we were expecting bullishness on the dollar. So in your gold model notes, the barometer, okay, that sets the stage is the bias for gold on the daily chart bullish or bearish? Okay, I've already outlined in the free model that I gave everyone last night. I've already outlined in month one content in the mentorship. And I've even gave you the bias on Wednesday, Thursday, and Friday for gold. And I said specifically that it makes it easy to sell short gold when the dollar is going higher. Okay? In your notes, the bias and the framework, if you will, the setup, or the stage rather, I'm sorry. The stage is bullish dollar is bearish gold. Bearish dollar is bullish gold. So they're inversely related. The correlation is inversed. So we were bearish on gold because we were bullish Thursday and Friday on dollar index. So right away, that's your mindset. Okay, I know what I want to do. I want to sell short. So now what do you do to study price action selling short in gold? You find your 7 o'clock in the morning hour, New York time, candle in your platform. Put a vertical line on that. Then study price action to the left of it. Now, I'm not giving you all the parameters here because a lot of this stuff the charter members will understand by utilizing the content from price action model number 5. It's basically the same thing there with this, okay? But from a simplistic view, for everyone coming from the free tutorials level understanding and while going through core content, if you simply just look at the consolidation in here and you just take that same range and use it as a standard deviation, project it up 1, and then project it down 1, 2 more, okay? Generally, a low volatility day, again, this is for algorithmic viewing and algorithmic teaching. Generally, you get 1 standard deviation up and 2 standard deviations down. Medium volatility will be 2 standard deviations up, 3 standard deviations down. That's all you're going to need to do right now, okay? Bearishness on gold equals bullishness on dollar. If you know you want to find really easy New York setups, trading in foreign currencies coupled with the dollar, okay? In other words, the dollar crosses. I told you the stage. Wednesday, gold was going to go higher. That means foreign currencies are going lower. That means gold is going lower. That means New York session, you're looking to sell short cable. You're looking to sell short Eurodollar. You're looking to sell short gold. Okay? Now, let's ring in some of the things you've already learned in month one. There's going to be a low resistance liquidity run, but we have to sell at a premium. The market has to go up first. So if the market's going to go up in gold when there's the context behind it or the underlying pinnings of the market is bullish dollar, bearish gold, any rally is a suspect rally. So anytime it goes up when it's generally bearish, we're interested in that because we want to fade that. The people on Twitter, Instagram, Facebook, even on TradingView, they're going to look to try to buy gold. And we're not. We're trying to sell short gold. So what we're looking for is a return to fair value, return to a bearish order block, run old highs, or breakers, bearish breakers. So we have relative equal lows here. Let's zoom back out here a little bit. You have a low here, and we have a low here. So any rally up, we're going to use that in the proper context. Now, we want to see price in a consolidation going ahead of the New York Open, and we want to see the standard deviation traded up too. Well, standard deviation's here. We get it here. You could be a seller there, but your stop has to be above this level here. It has to be above that. How much? Well, in gold, you want to use about a 5-point spread from your point of reference here. That's where you're anchoring your stop. And it has to be about 5 points above that. Oh, that's a big stop, Michael. Well, it's only big if you use a lot of leverage. So another opportunity would be if you don't see this initial run and it drops down here, okay, we have relative equal highs and price is not dropping considerably yet. It hits an order block that has a fair value gap in here. It hits it. We start to rally again. It creates this short-term high and it's consolidating here. So at that moment, price looks like this. It's got easy equal highs. Anticipate a run above those equal highs. That's your manipulation. At the same time, when this occurs, this rally up here, this is all a stop run. You're not going to get tripped in that. You're not going to be scared by it. You can use a limit order above these equal highs. Okay, between these equal highs and this high up here, you can split that range in half and use it as consequent encroachment, midpoint of that, and you'd be selling short right about here, which would really lower your necessity for the point difference between here and 5 points above an old high for going short. Shorting above these equal highs or shorting at this standard deviation, either one, your target is below these equal lows, minimum. But below these equal lows, you have one standard deviation that takes us down to here. That would essentially take us below these equal lows and to a normal algorithmic deviation. So the standard deviation of this range, we have one projection standard deviation up and we have one standard deviation projection down. This is the specific price level you're going to look for below these equal lows. You take profits there and then leave something on if it is not London close. At noon, you kill it. You just get out of it, okay, if it's a day trade. If it's a short-term trade, which is kind of like we had it set up for Wednesday's commentary, I said, Thursday and Friday, we're looking for gold to continue up into its low resistance liquidity run. That means as long as gold is running towards this high, you're staying short with the bias of selling short gold. The standard deviation number 2, down, takes us down to 1517. The low is 1517. Look at the time. It's around noon time, okay? So it goes to 2 standard deviations down. You're using power 3. You're using the intermarket relationships between gold to assume the bias. You're waiting for the manipulation. You're selling in highs. You're waiting for price to go the opposite direction, trading against the intended direction of your trade, which is going lower in gold. Now, you're probably saying this is all form-fitted, Michael. This is all just cherry picked. Well, let's go back. This was on Friday. All right, so here's the 29th of August. Same scenario. The market came down and then started ranging, which is what we want to see. Standard deviation of 1, take it up. Just falls short of the full level here. Now on gold, you're going to use the full point. You're going to go to the nearest full point. In this case here, the top of that candle or top of that range is 1545. So 1545 is the actual price you're looking for. You don't care about the little decimals. You're not worried about all that. You're not trying to split hairs with this model. The high is 1545. It didn't touch the actual rectangle, but it touched the price of 1545. So in your model notes, you're going to be rounding when you're trading up to a specific deviation. You're going to round to the nearest gold round full level, not round number in the sense that it's a 0, but whatever. Like if this was 1544 and some kind of decimals, it's 1544 is the level. Okay, you're reaching up to the nearest full number, not rounding up to 46 because it's calling for 1545. You're not going to say, okay, let's round it up to 1546. You're rounding down to the nearest full number. Okay. And we have one standard deviation down. So if you were selling short up here or in here, you would take profits there. Okay. Another standard deviation is here. You would take profits there. Third standard deviation. Okay. Remember what I said. More volatility, medium volatility is going to see 2 standard deviations higher, 3 standard deviations down. Okay. In this instance, we have only 1 standard deviation up and then 3 down, which is really nice. That's high volatility. Specifically rather for gold. So we have the market trading up in our 1545 level, and the low is 1520. That's the projected swing expansion on the downside, and the low is 1519 and basically a half. Okay, so we went not even a half of point for gold in a projection, and it does it on a spike here. Okay, are you going to complain about that? You're going to complain about just falling short of what? Not even what, 9 decimals, 10 decimals from your projected high, and it goes a half a point below where you thought it was going to go. The time of the day this occurs is late in the day. It's 1800 hours. That's the end of true day. Okay, so true day. Go back to your notes and stuff in the mentorship. If you haven't got that far yet, you'll get to it when you get into like day trading and short-term trading and things like that. I think that's where I have it. But that's true day, time of day. So the market trades beautifully in here. Okay. The open, rally, sell short, expansion to the downside, distribution. They're selling short, and they're not going to distribute their shorts by buying it back. And then you have that movement off of the low, trading near the low, but down from the open. This is power 3. Open, rally, sell off, down, smart money buys it back and consolidates into the new day. Folks, this works on every market in New York. Okay. I only outlined it and described it as a gold model because this is actually what I used this week. I used these specific models in my own study, in my own trades, in my own view of the intermarket relationships between gold and the dollar. This is what you get. Now, I gave you 2 examples when I actually told you in advance on Wednesday what the stage was. Bullish dollar, bearish gold. How do you use that information going forward? What I just showed you here. Okay? A lot of the things that you're going to see happen with precision is going to be largely directly linked to this structure here for New York. This is how I trade New York. This is the framework I use for New York, and I also know when I want to avoid New York. Like, I don't want to see a lot of directional trading, okay, in the short period just before New York opens, because there's too much noise. I'm just going to wait and see if there's anything else I can look for, and then I'll wait for the reaction at some point later in the New York session, and then wait for an imbalance and then sell short or buy a fair value gap or trade off a breaker. It's as simple as that. I mean, if you missed it all up here and you have all the context over here, we have a fair value gap here with the low there, 1534, and then we have the candle high here, 1533, and you're probably saying, well, it's not even that big of a difference. It's a gap. So split that gap in half. Bam. Let me zoom in. I know you're probably thinking, I can't even see it, Michael. This high. See if I can move that around a little bit so you can see it. Right there. It nails the consequent encroachment to the pip. Boom. And you're only looking to see it trade to the high here. So once it trades there, you can watch it live as it's trading, as it punches up in there and creates that big bold candle. Sell it short right there. It hits it. Bam. Hit it. Right at the consequent encroachment. And then you're positioned to ride it down to get the standard deviation to here and to here. Well, that's not a lot of pips, or that's not a lot of points, Michael. It's 12. That's $1,200 for a standard lot. $1,200 per standard lot. And these are only 5-minute candles. Really important. So you're using the 5-minute candle chart for your New York opening range. Whereas London Open, you'll see me teaching that it's the 15-minute candle that I use for the London Open and determining the standard deviations relative to the central bank dealers range, flout, and the Asian range. So there's very specific time frames for specific things. Okay, and it doesn't change. It doesn't flip-flop. I don't go back and forth. I only use the 5-minute this week and 15-minute next. These are just main staples in my content. Okay. So, what did you learn here today? You learned a model. You learned a New York Open price action model that is so generic that you can place any market into this. Any market. My advice is for you to go into other markets like oil, into futures markets like S&P, like the bond market, okay? And you're going to see an astonishing level of precision. And ask yourself, if it's really just a free market, if it's just all about buying and selling and supply and demand, how on earth, if everybody's predominantly wrong, how is it this precise and why is it acting like this all the time? Unless it's completely manipulated and controlled. And it's not just gold.